Welcome to my channel. Silver gained 148% in 2025. It hit an all-time high of $121.67 on January 29, 2026. Then it crashed 31% in a single day. Then it recovered 30+% from the lows. Right now it is trading in the mid-80s, and the market is debating exactly what happens next. But before you can answer that question, you need to understand the real architecture of the silver market, because most people fundamentally misunderstand what is actually driving the price. Silver has two completely different demand forces acting on it simultaneously. The first is industrial demand, factories and manufacturers consuming silver to make solar panels, electric vehicles, AI data centers, and electronics. This demand is structural, growing, and largely insensitive to price. The second is investment demand, retail investors, ETFs, hedge funds, and now sovereign wealth funds buying silver as a monetary asset, a safe haven, and an inflation hedge. This demand is sentiment-driven, volatile, and can reverse quickly. Here is the key insight. These two forces have different jobs in the silver market. Industrial demand sets the structural floor. Investment demand determines how far and how fast silver moves above that floor. Confuse the two and you will consistently misread where silver's price is going. Today we are going to dissect both forces with precision, what they are, what the latest data shows, and exactly which one is really moving the price right now. Section 1. Industrial demand. The structural engine. 0:55, 4 o'clock. Let's start with industrial demand, because this is the dominant force in the silver market and the one that is most misunderstood by casual investors. Industrial demand in 2025 accounted for approximately 59% of total global silver consumption, roughly 665 million ounces, per the Silver Institute's November 2025 annual Silver Industry Dinner presentation by Metals Focus. That is down 2% from 2024's record of 680.5 million ounces. And the story behind that slight decline is important and instructive. The primary cause of the 2025 dip in industrial demand was twofold. First, thrifting in the solar sector. As silver prices surged above $50 and then $60 per ounce in 2025, solar panel manufacturers accelerated their efforts to reduce the amount of silver paste used per cell, a process the industry calls thrifting. The Silver Institute confirmed that photovoltaic silver demand eased by approximately 5% year over year in 2025. Even though global solar panel installations set a new record high. The manufacturers installed more panels, but used less silver per panel. Second, global economic uncertainty from tariff policies and geopolitical tensions. Some industrial categories that were growing in 2024 saw modest restraint in 2025 as manufacturers managed inventory levels cautiously. But here is what the headline 2% decline absolutely does not tell you. The offsetting positives were real and growing. Saxo Bank confirmed that healthy gains in the AI data center segment and further growth in electric vehicle sales partially offset the solar thrifting effect. The Silver Institute specifically highlighted that AI-related demand is a new and growing demand stream that was not material in prior years. And crucially, the thrifting story has a twist that most analysts are missing. The transition from PERS to TOPCon solar cell architecture, the shift in the dominant solar cell technology that happened in 2024, actually increases silver consumption per cell by approximately 50% compared to the older PERS standard. As TOPCon continues to scale in 2026 and 2027, the per gigawatt silver intensity of solar installations will rise, reversing the thrifting trend. Industrial demand is therefore best understood not as a single static number, but as a multi-sector engine that has short-term fluctuations around a clearly rising structural trend. The underlying drivers: government-mandated EV adoption, legally committed solar capacity targets, AI infrastructure build-out, are not going away. They are accelerating. Crux Investors' analysis stated it precisely. The fundamental challenge facing the silver market is the disconnect between demand visibility and supply responsiveness. While industrial applications provide clear demand forecasting, particularly in solar, where installation commitments extend years into the future, mine supply cannot pivot quickly enough to address shortfalls. Section 2. Investment demand. The amplifier. 4 o'clock, 7 o'clock. Now let's look at investment demand. The force that determines not the floor, but the ceiling, and the volatility. Investment demand for silver encompasses four distinct categories: physical bar and coin purchases by retail investors, exchange-traded fund inflows from institutional and retail investors, jewelry and silverware purchases where the metal has monetary and decorative value simultaneously, and increasingly, central bank and sovereign wealth fund accumulation, a new and significant development in 2025 and 2026. Physical bar and coin demand in 2025 fell 4% to 182 million ounces, a 7-year low per the Silver Institute. The headline figure is misleading, however, because beneath it lies a dramatic geographic divergence. In the United States, the largest historically retail silver bullion market, There were substantial retail investor liquidations throughout 2025 at prices above $50, $60, and $70 per ounce. Many U.S. retail investors who had bought silver at lower prices were taking profits. This selling suppressed the bar and coin total significantly. Simultaneously, Indian retail investors were doing the exact opposite. The Silver Institute confirmed that Indian investors bought into rising local prices, expecting further upside. India's silver imports in 2025 rose 44% over 2024 in dollar terms to approximately $9.2 billion, even as prices in rupee terms nearly tripled. What does this tell us? It tells us that retail investment demand is highly price elastic and geographically fragmented. Rising prices in the US suppressed retail buying. Rising prices in India stimulated it. The ETF story in 2025 is dramatically different from physical bar and coin. Peel Hunt estimates net inflows to silver-backed ETFs reached almost 150 million ounces in 2025, with total ETF holdings rising to 864 million ounces by year-end. This represents an 18% increase in ETF holdings in a single year. Peel Hunt specifically noted that ETF holdings remain a structurally important source of demand and can accentuate price movements significantly. Perhaps most striking is the new institutional entrant, the Saudi Central Bank. Multiple sources confirmed that the Saudi Central Bank purchased silver ETFs in 2025, including the iShares Silver Trust, with combined holdings exceeding $40 million. This is noteworthy because central banks have historically bought gold, not silver. As Trading Keys analysis from January 2026 noted, Russia also began accumulating silver via emerging market channels in late 2025, driven by the recognition of silver's strategic value combining hard industrial demand with monetary characteristics. This sovereign accumulation trend is a new and potentially significant demand stream that did not exist in prior silver cycles, and it fundamentally changes the investment demand picture for 2026 and beyond. Industrial versus investment demand, head-to-head comparison, 2025 to 2026. Data, characteristic, industrial demand, investment demand, 2025. Volume approximately 665 MAs, 59% of total demand, approximately 182 MAs, bar/coin, plus approximately 150 MAs ETF, approximately 330 MAs. Price sensitivity, inelastic, factories can't easily switch. Price is small fraction of product cost. Elastic, high prices suppress retail buying. Lower prices stimulate it. Demand driver engineering specs, government mandates, technology rollout schedules. Sentiment, fear, inflation expectations, gold price, interest rates, predictability high, solar EV, demand visible years in advance via capacity plans. Low, can reverse in days or weeks on macro sentiment shifts. 2025, trend down 2% versus 2024 record. Thrifting plus tariff uncertainty offset. EV/AI gains, down 4% bar coin. US retail liquidations. ETF inflows plus 150 MAs structurally. UP price impact mechanism creates the structural floor. Persistent deficit that prices must reflect long-term creates volatility and spikes. Accelerates moves above or below the floor. Reversal risk, very low. Structural, driven by decade-long energy transition. High. And sentiment can shift fast. U.S. retail liquidated in 2025 despite price rise. Who controls it? Tech giants, automakers, solar panel manufacturers, governments, retail investors, ETF managers, hedge funds, central banks. New in 2025 to 2026, China export restrictions. Samsung C&T locked up Mexican mine output. Saudi Central Bank bought silver ETFs. Russia central banks accumulated. Verdict. Price driver structural floor, sets the long-term price direction amplifier, determines how far and how fast the price moves. Section 3. What the 2025 data actually shows. 7 o'clock, 9:30 SILD no. Now let's look at what the 2025 data tells us about the interplay between these two forces, and what it means for understanding silver's price behavior. The silver price in 2025 gained 148%, one of the most powerful annual returns of any asset class, but the breakdown of what drove that gain is the critical insight. Saxo Bank's December 2025 analysis of silver's breakout year is precise on this point. Silver's 2025 surge was driven by a rare alignment of monetary, structural, and physical market forces. 3 forces, not one. The structural force was the industrial supply deficit, the 6th consecutive year of more silver being consumed than mined. The physical market force was the tightening of above-ground inventories as cumulative deficits drained COMEX and LBMA vaults to historic lows. The monetary force was the investment demand, ETF inflows, retail buying in India and Germany, and the emergence of sovereign accumulation. Here is the crucial insight from Saxo's analysis. For manufacturers of solar energy, electric vehicles, AI and data centers, Silver is essential but represents a relatively small share of total production costs. Running out of supply is not an option. That statement explains why industrial demand is price inelastic. A solar panel manufacturer is not going to stop building panels because silver costs $80 instead of $30. Silver is perhaps 2 to 4% of a solar panel's total cost. The decision to install silver paste is an engineering requirement, not an economic choice. Investment demand, by contrast, is entirely an economic choice. When U.S. retail investors saw silver at $70 or $80 and had bought at $20, they sold. That is rational economic behavior. The Silver Institute confirmed this. U.S. retail liquidations were a significant drag on bar and coin demand in 2025. J.P. Morgan's Gregory Shearer made the same point from the institutional side. High prices have likely accelerated substitution and thrifting trends, and near-term price fluctuations will depend heavily on investment demand. This is the J.P. Morgan framework. Industrial demand sets the direction. Investment demand controls the near-term fluctuations. The Silver Institute's 2025 data fully validates this framework. Industrial demand was down 2%, a modest, expected thrifting-driven moderation. Investment demand via ETFs was up almost 88% in net inflows, an extraordinary surge. The price gained 148%. Which force drove the gain? Both, but they played different roles. Industrial demand maintained the structural floor. Investment demand drove the price dramatically above that floor. Complete silver demand breakdown by category. 2024 actual versus 2025 forecast versus 2026 outlook demand. Category 2024 MAS 2025 F, MAS Yo-Yo Y. Change 2026 outlook industrial, solar PV 244, approximately 230-5%. Rising as TOPCon scales, IEA plus 17%/YAR solar capacity. Industrial, EVs and automotive, approximately 65, approximately 68 plus 5%, 70 Solvive. MAS by 2026, CAGR 3.4% to 2031. Industrial, AI/data/5G/grid, approximately 12, approximately 14 plus 17%. Growing, fast, healthy gains noted by Silver Institute. Industrial, other electronics, approximately 359, approximately 353-2%. Stable base, modest growth from semiconductors. Total industrial 680.5, approximately 665-2%. Structural growth resumed in 2026. Investment bar and coin, approximately 190-182, 7-year low -4%. U.S. retail liquidations offset by India, Germany, Australia. Investment ETF inflows, approximately 80, approximately 150. Peel Hunt estimated Hain at 86.4 MAS N 2025. Saudi CB bought SLV. Investment jewelry and silverware, approximately 285, approximately 265-7%. AVG, India resilient, gold substitute. West softening on high prices. Total demand approximately 1,219, approximately 1,120-4%. Still runs 95 plus, MAS deficit versus approximately 813 MAS supply. Section 4, the interplay. How the two forces create silver's unique price dynamic. 9/30/11/45. Understanding the interplay between industrial and investment demand explains something that has puzzled silver investors for years. Why does silver sometimes trade like a commodity and sometimes like a financial asset? Why can silver gain 50% in 2 months and then lose 30% in a single day? The answer is that silver is simultaneously both, and the dominant force shifts depending on market conditions. In the base case, normal market conditions with modest macro uncertainty, industrial demand is the dominant price driver. Supply deficits accumulate quietly, inventories drain steadily, and silver prices reflect the structural fundamentals. The price rises, but gradually. In stress scenarios, high inflation, dollar weakness, geopolitical crises, financial instability, investment demand surges and becomes the dominant price driver. Sentiment-driven buying, through ETFs and physical silver purchases, amplifies the move dramatically above what the structural fundamentals alone would justify. The price spikes sharply and quickly. In mean reversion periods, after a speculative spike, investment demand reverses. ETF holders take profits. Leveraged futures positions get unwound, and the price corrects back toward the structural floor. The structural floor, however, is higher than the previous cycle because the industrial deficits have continued accumulating. This is exactly what we saw in the 2025 to early 2026 cycle. Silver's structural floor in 2024 was around $30 to $35, the level where persistent industrial deficits were beginning to price in supply scarcity. Investment demand in 2025 drove silver from $33 in early 2025 all the way to $121.67 by January 29, 2026, 369% gain above the structural floor. Then came the February 2026 crash to $63, investment demand reversing violently as speculative positions were liquidated. Silver's current price of approximately $84 sits above the structural floor, reflecting ongoing industrial deficits, but well below the speculative peak. The structural floor itself has likely risen since early 2025, because the cumulative deficit has continued accumulating. Metals Focus puts the 5-year cumulative deficit from 2021 to 2025 at approximately 820 million ounces. The implication for investors is concrete. The structural floor set by industrial demand and supply deficits is the level at which silver has historically found long-term support after speculative corrections. Saxo Bank frames the investment case exactly this way. Having spent much of the past decade oscillating between being perceived as a monetary metal and an industrial input, silver finally resolved that identity crisis in 2025 by being both at once. Section 5. So what is really moving the price right now? 11:45-13:30. Let's bring everything together and answer the central question directly. As of March 2026, with silver at approximately $84, what is really moving the price? The answer requires separating what is setting the floor from what is creating the current sideways consolidation. The structural floor is being set by industrial demand. The Silver Institute confirmed a 5th consecutive year of supply deficit in 2025, estimated at 95 to 230 million ounces depending on the source, with global mine supply essentially flat, at approximately 813 to 830 million ounces. Metals Focus confirmed that the cumulative deficit from 2021 to 2025 is approximately 820 million ounces. That is almost an entire year's worth of mine production that has been consumed above and beyond what was mined, drained from above-ground inventories, from COMEX vaults, from LBMA vaults, from private hoards. That structural deficit is the floor under silver's price. It does not disappear when the speculative excess is unwound. The sideways consolidation we are seeing right now, silver in the $80 to $90 range after the crash from 121, is investment demand finding its post-crash equilibrium. U.S. retail investors have done their selling. ETF holders who entered at lower prices have partially exited. The COT data confirms that managed money net longs are at historically low levels. Hedge funds are largely on the sidelines. The near-term price driver is therefore the question, when does investment demand return? Peel Hunt's analysis is explicit. Silver's dual role as a store of value and industrial metal provides ongoing support, but speculation has accelerated recent price gains. The structural deficit and strong industrial demand underpin the longer-term bullish view. JP Morgan is more cautious near-term, projecting silver to average $81 in 2026, while noting that near-term fluctuations depend heavily on investment demand returning. BNP Paribas is more bullish, suggesting silver could climb to $100 per ounce by end of 2026. The consensus: industrial demand has set a new structural floor materially above the pre-2025 levels. Investment demand will determine how far above that floor silver trades in 2026, and the catalyst for investment demand returning is most likely a combination of dollar weakness, Fed policy signals, and the next leg of gold's bull run, which tends to pull silver with it, often with more velocity. Closing 13:30-14:30. Here is the 3-part framework that every silver investor needs to understand and keep front of mind. Part 1. Industrial demand is the anchor. It accounts for 59% of all silver consumed globally. It is growing structurally. It is price inelastic. Factories cannot simply stop using silver because the price is high. It creates the supply deficit that accumulates year after year. It sets the floor under silver's price. As long as solar installations, EV production, AI data center build-out, and electronics manufacturing continue to grow, which government mandates and engineering requirements ensure they will, industrial demand will continue to push the structural floor higher. Part 2. Investment demand is the amplifier. It accounts for approximately 30% of total demand through bars, coins, and ETFs, plus the emerging central bank accumulation stream. It is volatile. It can surge and reverse quickly. It drove silver from $33 to $121 in 2025. It also drove the crash from $121 to $63 in 8 trading days. Investment demand will determine how far above the structural floor silver trades in any given period. Part 3. The interplay between the two is what makes silver uniquely compelling and uniquely challenging. Right now, in March 2026, industrial demand is holding the structural floor in the $75 to $80 range. Investment demand is rebuilding, with ETF holdings at near record levels, central banks beginning to accumulate, and hedge funds waiting on the sidelines. The question the market is asking is, when do those hedge funds re-enter? Because when they do, with the structural supply deficit running and industrial demand growing, the amplifier effect could be powerful. Subscribe for weekly silver market analysis. Hit like if this breakdown was useful, and drop in the comments. Do you think industrial demand or investment demand will be the bigger driver of silver's price over the next 12 months? See you in the next one.